Hello, everyone. Happy Sunday, one and all. It is Colby the DGI Crab, and it is strategy time, my friends. That is right. It is time to take a look at where the market is at on a Sunday and reserve a little bit of a time to make a plan, see what looks undervalued, see what your target stock purchases may, in fact, be for the coming week. Obviously, things can change really, really fast day to day. But it's a good idea to have some things that are on your watch list, things to keep an eye on that you might want to take some time to pounce on, maybe even sooner rather than later. Is the market about to correct? Well, hard to say, really. None of us really knows the answer to that. If I knew if the market was about to correct, I'd sell everything that I had, wait for the correction, and then rebuy everything at a lower price and come out a lot further ahead as far as my dividend income goes. But I don't have that crystal ball. I don't think any of you do either. So, in that case, why do I feel like there could be a market correction? Well, we've had a pretty stable, ever increasing stock market for a little while now. I feel like 2022 was the last kind of disappointing year that we had in the market. So, it just seems like from that perspective, just being a numbers game, eventually the market can correct. We've been working through government shutdown. That can be things that are pretty scary. And also, October and November just tend to be sometimes kind of odd months in the market, just in general. It doesn't impact my investing one way or the other, and I hope that it doesn't do yours either. But just if you're frustrated that you don't feel like there's enough bargains in the market right now, there eventually are going to be some. Just continue to hammer the ones that are still cheap right now and wait for your buying opportunities for some other things. I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes. Do your own due diligence before investing. My personal strategy that I share here with you every week is as follows. Half my money goes into age appropriate ETFs for automatic diversification. And I'm looking for stocks yielding 30% or more above their 4-year average yield, but not just any stocks. I'm looking at a list of 60 dividend growth stocks that I believe are the cream of the crop when it comes to dividend growth stocks. And I've subcategorized those into four separate tiers based on age and time horizon of the investor, which I believe is the most important metric any dividend growth stock investor should take under consideration. You'll see what I'm talking about here in a moment. For those of you who've been around for a little while, you know exactly what I mean. Now, I do within that group of 60, I have a group of top 10 favorites that I just love them, and sometimes I'll ignore my own 30% or more metric just because I'll want to add to those positions, make sure that they are good, strong positions in my portfolio. And I stay in my own age tier unless there are some other stocks yielding at least 50% or more above their 4-year average. And then at that point, I want to jump right in and get the higher starting yield and the higher chance for share price appreciation. So first, as we jump into the spreadsheet here, I'm going to start on my top 10 favorite stocks tab. These are the ones that are permanently on my watch list, that I'm permanently in a position of trying to find a way to build those up. I've gotten a lot of opportunities to build my Pepsi position. As you can see here, it is yielding 25% higher than the 4-year average yield. 2.96% is the 4-year average starting yield. 3.7% is what you can get Pepsi at right now at this share price of $153 a share. We've been buying this up together, I would hope, when it was yielding above 4% and the share price was down in the 130s. But even at 153, I still like it. I'm still adding. I also am I'm pretty happy to add to Procter and Gamble and Union Pacific right now. Union Pacific, I'm going to be adding a little bit to this week. I'm not going to be in the age tier that Union Pacific is in for too much longer, so I'm just going to trickle a little bit of money in there. I love the biggest railroad in the country. And Procter and Gamble, hey guys, everybody that is watching this video, I guarantee you somewhere in your house you've got at least a couple of Procter and Gamble products. So that is just one of the mainstay dividend growth stocks in any dividend growth community. Don't talk trash on Procter and Gamble. All right, everybody. So let's switch over to tier one. This is the 18 to 30-year-old investor category that is comprised of very low starting yield stocks, but very rapid dividend growth. We're trying to get 10% or hopefully even higher than 10% year over year dividend growth out of this group of stocks. For you young folks, you want those compounders to compound and grow your passive income through dividend increases. United Health and Nike and Nordson. These have been the three dogs in the category for quite a while right now. Fear not, as far as I am concerned. United Health has already shown some signs of recovery after cratering all the way down below $300 a share. Nike has just spent the last year plus with their share price being way down all the way to 2018 prices. And their starting yield has been comfortably above 2% for that entire time. And I just keep adding a little bit of money to Nike every single week. I'm not worried about their dividend. I think they're going to continue to grow their dividend. If they decide not to, it's certainly not because they don't have a big pile of free cash flow to continue doing it. And if they cut their dividend, then I'll cut them out of my portfolio and add something else to my group of 60. But I don't think they're in any danger of that at all right now. And I think they're going to work their way out of this eventually. And I'm happy that I've been adding Nike yielding 2.5% or better for quite a while now. Tier 2, age 31 to 41-year-old investors. We've got a bit of a higher starting yield here, more in the average range is going to be in your 2.5%. We're usually looking to buy this stuff when it's in the 3% range. We want to get high single digit annual year over year dividend growth in the 7 to 9% range. Target continues to be way down. You can continue to add Target at a 5% or better starting yield, which I'm very comfortable doing. Not expecting rapid dividend growth out of Target. I want to emphasize that. They've been growing their dividend a lot slower in recent years, and I think they will probably have another year or two of slow dividend growth. I don't think they're going to break their streak of consecutive dividend increases. I'm not worried about that at all. They just did a very small dividend increase recently to keep their streak alive. But adding starting income with a dividend king like Target, I'm perfectly fine with that, even here at tier 2. American States Water and McCormick, two of my absolute favorite dividend growth stocks, regardless of tier. They're not in my top 10, but very close. They're definitely in the top half of this group of 60 because they're both so stable as far as their dividend growth goes, and you can just pick and choose your time to add to them. Share price is pretty steady, pretty clear when they're cheap, pretty clear when they're expensive. Right now, they're on the cheap side, so I'm going to keep adding them. And, bidding say la vie to adding Hershey. Guys, I was adding Hershey for such a long time, and I've pumped the brakes on that for right now. They've gotten a little bit too high. Still not a bad value here at 27% underpriced, but I would still be favoring McCormick and American States Water and Target above them. Tier 3, age 42 to 53. More of a higher starting yield than tier 2. We're getting into that 3 to 4% range. We still want to get around 5-6% dividend growth overall out of the group. Hormel is the one that is in the basement right now. They've been down for a long time. Their 4-year average yield this week, you guys, and I update this number every single week, so this is very up-to-date information. 4-year average yield eclipsed 3%. And, that's really kind of a bummer with Hormel because, back when over a year ago, back when I started the channel, the Hormel 4-year average dividend yield was a lot closer to 2.5%, and it just continues to be a stock that is down. And the longer it stays down, the more the 4-year average yield climbs up to the point where it looks less appealing. Case in point, you look at a stock like T. Rowe Price that at one point was a $200 a share stock, and still has a long history of dividend increases. But this was a stock for a long time that was very consistently raising their dividend in the 10% range year after year after year or better. And really, ever since the COVID crisis, they have absolutely slammed the brakes on their dividend increases. They've been doing increases more in the 1 to 2% range for a while now. Their share price has been down for a very long time, currently yielding 4.9%. If T. Rowe Price in 2022 was yielding 4.9%, it would have looked like a stunning bargain. And I believe at one point in 2022, it may have been yielding 4.9% and looked like a stunning bargain. But that 4-year average yield since then has just continued to take up and up and up and up. And now the dividend yield in the fours just looks more like normal, not bargain. So if the stock stays down for a long enough period of time, it can reset our expectations for when it looks cheap and when it doesn't. But for right now, only Hormel looks cheap in this category. As I mentioned, Pepsi and Procter & Gamble are still perfectly fine targets for me just because I love them that much. Also, guys, little victory here saying say la vie to ADM. This was the one that was the most undervalued stock in the category for just months on end, yielding well above 4%. My Archer Daniels Midland position is looking pretty fat and happy. Definitely up on the share price, no question about it. And the yield on cost is well above 4%. I've had dividend reinvestment that's been hitting that for a long time now when the share price has been down. And just looking like a strong position. Same with GPC. I hope you guys sprung on that one when it was trading down in the $115 range, yielding above 3.5% now. Not quite as much of a bargain. So when you see recovery stories like that, you just got to keep in mind that that's kind of what we're going with here. And then the question becomes with stocks like Hormel, Target, Nike, are they going to look more like T. Rowe Price and just stay down and reset their average? Or are they going to eventually recover and look a little bit more like GPC or Hershey or ADM? Time will tell. Tier 4, age 54 and older investors, we want to get a good high starting dividend yield here. When you hit 54 and you're still adding to your passive income in order to retire, you're still actively working to do it, you don't have a lot of time left in comparison to the 20-year-olds out there to let those super compound dividend growers do their thing. You got to grab your money while you can get it. Now, I still want to get 2 to 4% year-over-year dividend growth out of this group of stocks, just cumulatively, but the starting yield is definitely going to be more important the older that you get. And right now, it's no major changes in this category. Once again, nothing super appealing in the high yield category. I thought that with the interest rates potentially getting cut, we might start to see some of this high yield stuff look a little bit less appealing. But time will tell. I was incorrect because I was thinking when the Fed started raising interest rates, some of this higher yielding stuff would look less appealing because if you were just conservatively sitting on some cash, you might just take your 4.5% you were getting out of a high yield savings. Or if you were worried about the market, you could put your money into something really, really conservative like no penalty early exit CDs. You could have gotten those in the 5.5. Some of those were pushing maybe 6% at one point in time at the peak of the interest rates. And I thought, well, maybe people would just rather do that as opposed to the more inherently risky high yield stocks. And I think what ended up happening instead is people took their money out of the stuff yielding 2 and 3% and just put it into the stuff that was yielding higher than that. And makes sense. But I think that was me misreading the market a little bit on how I thought it would affect these high yield stocks. So maybe if the Fed cuts interest rates again before the end of the year, we'll see some of these go back down, correct a little bit, and we'll have some buying opportunities. Some of the BDCs, just ARK and Main are my primary BDCs that I care about and invest in, but ARK is starting to at least be yielding above the 4-year average, and BDCs could get hit when the interest rates start to get lower. All right, you guys, the strategy, I don't have a whole lot of time to explain it this time, you guys, because I want to keep this video under 15 minutes, and I explain this each and every week. So go ahead and take a screenshot here if you like. These are my allocations right now for each of the tiers for the week. This is how I'd be allocating about the first half of my money. And then the second half of the money would be about like this. I've got my priorities in each of the tiers, or I'm going to start with the stuff in my own tiers and then move into the really undervalued stuff in the other tiers if I need to. What are you all buying this week? Let me know in the